So the first thing that I wanted to chat to you about is like understanding risks of different assets in the different size ranges within commercial property. So for somebody starting out, they're going to buy something between the $1 to $3 million range, and then they're probably going to move like 3 to 10 million, and then 10 million plus. When somebody's starting out in that $1 to $3 million range, what sort of assets would you say have the least amount of risk for a beginner? And if so, how and why?
Yeah, look, I think it's pretty market specific. Like it would differ, I guess, location to location. But look, I think every asset has its own sort of individual risk profile, which, the kind of main categories as a valuer that we sort of try and analyze risk through is like cash flow specific risks, asset specific risks, and then kind of market specific and management risks. And you can kind of look at all different asset classes and types through that same sort of risk profile. I guess in terms of, sort of more of an entry level commercial investment, you're probably going to have a single tenant property. You might have maybe if you had a sort of smaller multi-tenanted industrial building, you might have a few tenants, which complicates things a little bit more. But I guess probably something to go through, just say a typical single tenant industrial property, or it could be really any asset class. That might be a good kind of example to go through. So it's your question around like what are some of the risks you need to be aware of?
Yeah, the question is like, what for a beginner, what should we, what's the first sort of property that we should be buying? I mean, it could be asset type, but then how do you, like, I know for residential, it's typically get your borrowing capacity and then work out like what you can buy, what type of asset that you want to purchase in your portfolio, and then go away and then look at the market conditions and find that asset in the correct market conditions. So how do you go, like with commercial, say I work out, okay, cool, I can get finance for a $1.5 million deal, know what my deposit is. Do you then go market conditions first or asset type first? In my head, I'm thinking asset type first and then market conditions and then cash flow after that. Like what's, was it?
I understand what you mean now. So I think, well, generally speaking, investors should be driven by yield or level of return. Mm-hmm. And generally there's a relationship between risk and return. So for an asset that might be, have a perception of being more risky, you would expect a higher return. So I guess it kind of depends, initially on your own, appetite for risk. If you're someone who's like, for instance, as an example on the Gold Coast, the industrial market is probably less risky than the, retail and office markets. But at the same time, the yields are firmer. So you're going to get a smaller return for your investment in that space. So if you've got maybe a slightly more, higher risk appetite, you might actually get a better return buying, a entry-level retail or office property. But again, they sort of come with their own inherent risks, if that makes sense. So I think the sort of driving factor should be really return, and that cuts across all markets. And that's probably a good place to start.